My feed is filled with people setting their hair on fire, screaming about how the housing market is going to collapse in 2025. And I want to take them seriously. They seem quite sincere. But the thing is they were saying the same thing going into 2024, 2023, 2022. They have been saying this for years. And I have to applaud them, right? Like, they are committed to the fact that there will be a housing crash. And the thing is if you beat that drum long enough, eventually you're bound to be right, because housing does tend to be cyclical, and every now and again there do tend to be huge crashes in the real estate market. So the question is there some new legitimacy to these claims? Is there reason to be setting our hair on fire and expecting the housing market to crash in 2025? That is exactly what we are going to explore in this podcast episode. That's right, you are listening to the DIY Homebuyer Podcast. I'm Nick, your host. I create this podcast primarily to help you buy a home without needing to hire a costly buyer's agent. I do that by teaching you what you need to know to successfully navigate the home buying process with confidence. Why would I do that? One, because I love helping people save money, and two, because I believe it's a better way to buy homes, that you get far greater control over the home buying process. You get a great education, you gain valuable skills. I am all about it. And if you haven't joined our free school community for DIY homebuyers, let me tell you, you're missing out. There are amazing resources, all for you, all for free, including an incredible community of folks to connect with. So go to school, SKOOL.com/DIY homebuyer. Be sure to join us there. Now, let's get into the show. So, are we headed for a market crash? But we're going to look at this question from an angle that most people aren't talking about. And that's the massive consumer debt crisis that is brewing beneath the surface. Now, let's start with a number that should get your attention. Americans now owe more than $1 trillion in credit card debt. That's not just a record, it is a warning sign. And when you combine that with 7% mortgage rates and median home prices still hovering around $410,000 nationally, we might just be looking at the perfect storm. But before we dive into how this could all play out, let's look at where we are right now. The median home payment has jumped from about $1,500 to $2,400 in just a few years. That's a $900 increase for the exact same house. Meanwhile, credit card interest rates are averaging 24%, and the minimum payment on that $1 trillion of credit card debt are starting to squeeze homeowners like never before. Now, a lot of people are comparing this to 2008. But what we're facing today is actually quite different. In 2008, the problem was bad mortgages. Today, we're looking at a potential crisis driven by consumer debt. And here's why this matters. First, let's talk about what happens when homeowners get squeezed from both sides. They've got these higher mortgage payments from buying at the peak of the market, and they're trying to juggle growing credit card minimum payments. When you have this juggling match, well, something's got to give. So let's break down the numbers. The average American household with credit card debt owes about $10,000. At 24% interest, that's $200 in interest alone every month. Add in minimum payments, and you're looking at $400 to $500 monthly just to stay afloat on credit cards. Now, layer that on top of an increased mortgage payment. This is where things get concerning, and we're seeing three dangerous trends converging. One, rising essential costs, higher mortgage payments, increased property taxes, growing insurance premiums, and rising utility and maintenance costs. Two is consumer debt crisis. There's record high credit card balances, personal loans are at all-time highs, buy now, pay later debt is exploding, and the average credit card rate is over 24%. And three, we have wage growth slowdown. So salary increases are not keeping pace with inflation. The job market is showing signs of cooling. Savings rates are at historic lows, and emergency funds are depleted. Here's where this could hit the housing market. Unlike 2008, we might see a wave of voluntary sales and foreclosures, not because people can't afford their mortgages directly, but because they're drowning in consumer debt. Think about it. If you have $300,000 in equity in your home and $50,000 in high interest debt, selling your house might start looking like your only way out. And that is what economists call distressed selling. And it's different from 2008 because people have equity in their homes this time. They're just trapped between bad options. Now, here's where it gets interesting for the housing market. We're still dealing with a housing shortage. As I've mentioned in other podcast episodes, we're about 4 million homes short of what we need nationally. But if we start seeing a wave of these distressed sales, well, it could create pockets of increased inventory exactly when buyers are struggling to qualify for mortgages. So let's talk about the regional impact because this won't hit everywhere equally. Markets with the highest concentration of recent buyers who also have high consumer debt are the most vulnerable. Think about areas with lots of first time homebuyers who stretched to get in during the past few years. And here's another thing that most analysts aren't talking about: the credit score impacts. As people max their credit cards out and miss payments, their credit scores drop. And this creates a dangerous cycle. Lower credit scores mean you can't refi. And when you can't refi, you can't consolidate your debt. And when you can't consolidate your debt, it means you're stuck with high interest payments. And high interest payments mean more likelihood of missing payments, which then just causes the cycle to continue. For current homeowners, there are a few critical steps to consider. One, look at your total debt picture, not just your mortgage. Two, consider debt consolidation while your credit score is still good. Three, look into selling before you're forced to if you're truly underwater on consumer debt. And four, explore mortgage modification options, which are more available than most people realize. Now, for potential buyers, here's what you need to focus on. One, put your emphasis on clearing high interest debt before even thinking about a house. Two, build a larger emergency fund than you think you need. Three, be extra conservative in your housing budget calculations. And four, consider waiting until you have a larger down payment. Now, for a market forecast, here's what I think we might see, beginning with the first wave of changes, which I think will happen in the next 6 to 12 months. I believe we're going to see an increase in voluntary sales from people using equity to clear their debt. That will lead to rising inventory in certain markets. And whenever there's rising inventory, that puts downward pressure on prices in areas with higher consumer debt. Then in 12 to 24 months, I think that we will see a second wave that will include an increase in foreclosures if the consumer debt crisis deepens. This will lead to more significant price corrections in overheated markets, and there will be a possible credit crunch as lenders tighten their standards. But it's not all doom and gloom. There are several factors that could prevent a full-scale crash. One, strong employment. Most homeowners still have stable income, and by and large, the job reports are pretty good. Two, tight lending standards. Current mortgages are generally solid. Homeowners do have a lot of equity, which means that homeowners may have creative ways of pulling some of that equity out through HELOCs or cash out refinances so that they can free up that equity to pay off debt without having to sell their home. Three, as I mentioned, there is a housing shortage. We still don't have enough homes across the United States, and that means there's not enough supply to meet demand, which generally leads to stabilization of pricing. And number four is bank stability. And I'm sure that someone will argue with me over this, but financial institutions on the whole have never been better capitalized. So here's the key takeaway. While I don't believe we're headed for a 2008 style crash, we might be facing something different. I would call it a credit driven housing correction. And the key is to watch consumer debt levels as much as housing metrics. Now, if you're struggling with both housing costs and consumer debt, don't wait until you're underwater. Take action now while you have options. And if you're thinking about buying, make sure you've got your consumer debt under control first. Remember, what we're seeing is not a housing bubble, it's a consumer debt bubble that could spill into housing. Understanding the difference is crucial for making smart decisions in today's market. Now, that's all I've got for you in this episode. Like I said, I know that this one isn't directly related to how to buy a home without an agent, but these are critical factors to keep in mind as you're thinking about your home buying journey and as you try to predict when is the right time to buy a home. Now, it is impossible to time the market. So there is no sense in truly waiting for a housing market crash. And again, I don't think we should be using the term crash. I think, if anything, what we should be thinking of is a housing correction. But because there are so many people that have been waiting to buy, as prices come down, more buyers are going to enter the market, creating more competition. And so, what I think is that if you want to buy a home, you need to make the decision not based upon big macro, what's happening out there in the market factors, but rather based upon your own personal situation. When do you have the savings, the down payment, the stability to afford a home that you want and see yourself in for 5+ years? And if you have all of those things and you can comfortably afford a home, then now is the time to buy. And if you don't have all of those things coming together, or you can't afford a home right now that you would be happy in for 5+ years, then you should wait. And fortunately, rent has never looked better compared to home ownership with interest rates being where they are. And I know that's probably an unpopular thing to say on a channel that's geared towards home buyers, but that's the honest truth of it. There is no shame in renting while you're waiting for your personal situation to improve so that you can afford a home that you actually want to live in for several years to come. So that's what I've got for you in this episode. Like I said, do connect with us in the school community completely free, skool.com/DIY homebuyer. That's an amazing space to be able to connect with me. Short of doing that, please do subscribe to the show, like the video, leave a comment, anything that you can do to engage with this. Even if you totally disagree with me and think that I am full of you know what, I want to hear it. All engagement is valuable to me because it helps make me sharper, better, helps me know what questions you have. And if you're loving what you're hearing here, you engaging helps more people discover the channel, discover the content, and hopefully elevates the consumer experience over the entire real estate industry, which is what I'm wanting to do. I'm wanting to be an agent of positive change within the real estate industry, and I can't do that without your help and support. So, as always, thanks for listening in. I'll be back with you next week. Until then, happy home buying.